Hi guys! This one tool will save you thousands of dollars from overdue credit card bills or help you reduce your cost of borrowing so that you can have better cash flow for your businesses or anything that you need. In fact, some people even use this method to borrow cash at a lower rate and put the cash to work in a higher interest yielding account. For those who owe overdue credit card bills and are paying 27.8% of sky-high interest, this tool is very beneficial. This tool is called balance transfer. Huh? What is balance transfer? Can eat one or not? Cannot eat, but it can help you to earn money, save money so that you can eat. Don't worry, by the end of this video, you will have a clear understanding of what a balance transfer is, the cost savings it can bring, how it works with all the fees and repayment schedules, the eligibility criteria, how it affects your credit score, and how is it different from a personal loan. Basically, everything that you need to know about balance transfer. This is Audz, your lobang sis, who simplifies complex money matters and curate good deals so that we can huat together. Let's start with the basic. What is a balance transfer? A balance transfer is when you move your credit card debts from one bank to another bank that is offering a lower or even 0% interest. That way you can pay less interest and clear your debts faster. Make sure that you have a plan to settle everything and gao tim until sui sui before the promo period ends. Otherwise, the high interest will come back and haunt us. Sis, can earn credit card cashback or miles or not? Typically, no. And even if they gave you some form of cashback, you will still be net negative. I will be mentioning certain banks to give you context. They are mentioned purely for educational purposes and you should do your own research to decide which balance transfer you want to use. So how much can you save if you choose balance transfer? Let's do some math. I'm going to use DBS website as an example to show you the difference of how much you would usually pay with and without balance transfer. Say we owe $10,000 on a credit card from Bank XYZ, which charges 24% interest per annum, and DBS offers a balance transfer promo with 0% for 12 months and a processing fee of 4.5%. As you can see, instead of paying $2,400 of interest, we only pay $450 of fees. That means we can buy how many plates of chicken rice already? Balance transfer can really help you save big as long as you use it wisely. And you know what else can help you save big? Following my channel by hitting the subscribe button. So how do balance transfers work? Here are 3 general steps. First, you can apply a balance transfer with a bank offering a good promo rate, and if approved, the bank helps you to pay off your old credit card debt. Now you will owe the new bank but at a much lower interest rate for the agreed period. Make sure you pay everything back on time and in full, or else you will be back to square one, okay? So what are the fees involved and what is the repayment schedule like? Firstly, there is a processing fee which involves a one-time payment charged to your credit card or credit line upon approval, and this is typically added to the balance. In Singapore, it typically ranges from 1.5% to 5.5%. Let me show you an example. Let's say you transfer a balance of $5,000 with a processing fee of 1.58%. After adding the fees, your total balance becomes $5,000 plus 1.58% of that $5,000, which is $5,079. Now let's move on to the monthly repayment schedule. Usually the monthly repayment amount in Singapore is between 1% to 3% depending on the bank. And here's how the repayment schedule will look. 1% of $5,079, which is $50.79. This means that you must pay $50.79 every month for the first 5 months, and in the 6th month, you need to clear the remaining balance before the 0% promo ends. And you should also take note that this $50.79 should be made on time and in full. If not, you'll be slapped with a late payment fee according to the bank's fee table. So the amount payable on the final month will be the balance transfer amount minus the monthly repayments each month times the tenure minus 1, which is $5,079 minus $253.95, and that will give you $4,825.05. Is there a minimum or maximum amount for balance transfer? Yes. Banks in Singapore usually have a limit on how much you can transfer. The The minimum amount set by most banks is between $500 to $1,000. The maximum amount is typically 90% to 95% of your credit limit, and this is dependent on the bank as well as things like your income, credit score, and outstanding debts. For example, if your credit limit is $10,000, then you can likely transfer up to $9,000 to $9,500, inclusive of the fees. But remember, this is not guaranteed, and the actual amount approved is totally up to the bank. You should check with your bank for specific terms before proceeding. So who is eligible for balance transfer? Only the principal card holder or someone who owns the personal credit line account can apply for a balance transfer. And here is a quick rundown of other usual eligibility criteria. You must be above 21 years old. Minimum annual income ranges between $30,000 and $50,000 depending on the bank, and having a good credit score. In Singapore, it is above 1,000 on the Singapore Credit Bureau scale. It gives you a better chance of approval and may land you better terms. And finally, the bank relationship. If you are an existing customer of the bank that you are applying to, you might get preferential rates or faster approval. How does balance transfer affect your credit score? A credit score reflects your credit worthiness and helps financial institutions assess your risk as a borrower. It is primarily influenced by your payment behavior, and usually late payments have significant negative impact. Maintaining timely and consistent payment, whether it is for balance transfer or personal loans, can help you protect your score. A strong credit score is even required for you to be approved for balance transfers. And as long as you keep maintaining consistent and timely payments, your credit score will improve and it will go up. Now you must be thinking, sis, so what about personal loans? Should I use that instead? Well, balance transfers and personal loans work very differently. Balance transfers are best if you can clear your debt quickly, chop chop curry pok, within 6 to 12 months because of its 0% interest. And the charges are relatively lower. But if you need more time to pay, like 2 to 5 years, then a personal loan might be better. The interest rates might be higher, but the fixed monthly repayment gives you stability and predictability. It's good if you're planning your budget long term. Take note that personal loans have early repayment penalty. In conclusion, balance transfers are helpful in consolidating debt, help you save on interest and become debt-free quicker. You can make the most out of your balance transfer by paying off the full amount within the interest-free period. Otherwise, high interest and late payment fees can quickly add up. You can use balance transfer wisely as a temporary solution to manage high interest debts or cover emergency expenses. If you have found this useful, do me a favor, like and subscribe, and share this with your friends who might actually need something like that to sort their finances. Together we can save more, stress less, and enjoy life more. I hope this helps. Let me know what you guys think. Okay, thanks, bye!